We bring you a high-stakes, urgent financial bulletin on a major development out of Vietnam's monetary system. Claims suggest the State Bank of Vietnam has launched a fixed exchange program for the Dong, effectively ending fluctuations and locking in a set value against the US dollar. According to emerging reports, traders, corporations, and exporters have been given access to a newly mandated fixed conversion rate, rumored to be approximately VND 3.24 per USD. While this would represent a seismic shift in Vietnam's currency management strategy, we must emphasize that no formal statement has yet been issued by the state bank confirming a rigid peg. Still, investor chatter is intense, and the implications could be vast if substantiated. The rumors have swept through financial forums and regional business networks with remarkable speed. Users report being told that Vietnam has transitioned from its managed floating or crawling peg system, which previously allowed the Dong to drift within a narrow plus or minus 5% daily band around a central rate, to an outright fixed exchange policy. If true, exporters to the US and import-dependent firms would suddenly gain certainty. They could budget costs, structure contracts, and hedge currency risks with newfound precision. But at present, official documentation remains elusive, and policy materials available from state channels still reflect a flexible managed float. Should such a program be confirmed, it would mark a turning point in Vietnam's monetary history. Since 2016, the Dong has operated under a managed float system, adjusting gradually to market conditions. In October 2022, that allowed movement within a plus or minus 5% band around the reference rate. As of late 2024 and early 2025, trading hovered near VND 3.24 per USD, with commercial banks transacting at fringe levels between VND 240 and VND 540 as measured by buy and sell spreads. A shift to a fixed rate might stabilize prices, control speculation, and support macroeconomic planning, but only if fully endorsed by the central bank. Yet the fundamentals behind these claims remain uncertain. Vietnam has previously intervened when exchange pressures mounted. In early 2025, interest rate cuts lowered lending costs to support growth, but Deputy Governor Dow Minh Tu acknowledged that foreign inflows and capital rotations could pressure the Dong. The SBV has consistently emphasized flexibility in its foreign exchange strategy, even signaling readiness to act, but stopped short of announcing a rigid peg. Its reserves, estimated at around $86 to $100 billion, are substantial but not inexhaustible. The move to artificially fix the currency may therefore expose risks if external shocks occur without room for intervention. Demand for confirmation has prompted financial professionals to advise patience. If the SBV has launched such a program, one would expect official press announcements, circulars to commercial banks, guidance on eligibility, and details on how daily reference rates are set or preserved. At present, no such documentation appears on central bank websites or through major financial outlets. Without that, speculation may remain just that, even as markets react psychologically to the rumor. If you hold Vietnamese Dong, whether as cash, bank deposits, or trade credits, you may find offers floating on private channels claiming special access to the fixed-rate window. Some sources suggest exporters and corporate clients will be prioritized, while retail holders may face restrictions. Others tout internal contract rates and early-tier appointments. These elements mirror structures common in speculative currency networks, where promise eclipses proof. Until formal mechanisms are visible, investors should avoid making decisions based solely on hearsay. Market participants, including foreign portfolio managers and trade-oriented firms, emphasize that a fixed exchange program would require careful calibration. It would depend on predictable trade flows, solid reserves, foreign exchange liquidity, and coordination with the IMF or global capital partners. Sudden revaluation could destabilize corridors of investment, disrupt regional trade competitiveness, and ripple into inflationary pressure on imports. Considering Vietnam's reliance on export-driven growth and foreign direct investment, rapid or rigid changes could prompt unintended consequences. Current economic conditions offer mixed signals. Export values reached around $239 billion by mid-2025, with imports roughly $231 billion, indicating strength in trade balance. Credit growth has surged, and GDP is projected at 6.8 to 7% in 2025. Inflation is expected to remain around 3.8%. These figures suggest solid, if not overly explosive, momentum. Vietnam's government appears focused on maintaining macroeconomic stability through flexible interest rates and measured liquidity support. All of that aligns better with a managed float rather than a fixed-rate regime. Nevertheless, the allure of certainty underlies the speculation. Business leaders and investors are drawn to the promise of zero fluctuation in rates. Eliminating volatility would simplify contract pricing, budgeting, and hedging. Firms could hedge currency risks more cheaply, and exporters could lock revenue rates at a dependable level. Yet this fixed-rate narrative remains unsubstantiated. Proof through circulars, interbank guidelines, or official treaty clauses has not surfaced. Watch for specific signals. Should the SBV confirm a fixed rate, you would likely see daily reference rates published without variance. Internal bank memo updates, commercial bank exchange desks aligning spot rates strictly to the official rate, and trade clients receiving instructions on how to book transfers. None of these systems currently reflect a fully static mechanism. Even if some large corporate or export clients receive provisional access, public channels remain unchanged. Scanning trusted financial feeds, institutional bulletins, and central bank releases remains essential. For holders concerned about potential conversion windows closing or missing out on locked-in rates, patience may be the best strategy. Avoid chasing private intermediaries or paying fees to alleged facilitators. These scenarios often mask misuse, with individuals paying upfront for promised rates that fail to materialize. Instead, focus on gathering documentable evidence, signed rate confirmations, transaction receipts, bank memos, or central bank notices. If no such proof arrives, the claim could vanish as quickly as it appeared. It is also wise to consider risk management. Holding large volumes of Dong amid speculation may be tempting, but if the fixed program unravels or remains partial, expectations could sour quickly. Consider diversifying holdings or retaining a portion until clarity emerges. Investment professionals stress that acting on rumors in currency markets can backfire, particularly when systems are unanchored. We note from analysis that Vietnam's monetary policy stance remains flexible. The central bank has signaled it will continue to manage exchange rates according to market conditions, supply and demand dynamics, and inflation trends. Statements from early 2025 indicate no departure from this approach. No credible announcement has confirmed a rigid peg. So while rumors of a fixed exchange program are appealing, reality remains uncertain. In closing, the claim that Vietnam has launched a fixed exchange program for the Dong, ending all fluctuations, is currently unverified.